In many rich cities, rent has stopped behaving like a normal price. It behaves more like a monthly admission fee to participate in the economy. You can work full time, do everything right, and still feel one renewal letter away from leaving. That isn't just bad luck, it's the housing system expressing its incentives. The global housing shortage is not a single shortage. It's a physical shortage of homes in specific places, layered with a financial system that rewards scarcity. Start with the basics. Where jobs and universities concentrate, people follow. If housing supply doesn't expand at the same pace, rents rise until someone is forced out. In the US, widely cited estimates put the housing shortfall in the millions of homes. In Canada, major national estimates have argued the country needs millions more homes by 2030 to restore affordability. The UK has repeatedly aimed for around 300,000 homes per year and often fallen short. Across many OECD cities, housing costs have outgrown incomes for decades, not months. A useful way to think about shortage is vacancy. When vacancy is low, households compete with each other. When vacancy is high, landlords compete. Many expensive cities operate with very little slack, sometimes near historic lows. In that environment, even a small inflow of people or a pause in building can move rents sharply. Just build more sounds simple until you ask who controls permission. In many high-demand metros, the binding constraint is not engineering, but politics. Zoning decides what can exist on most urban land, and in many places it mostly legalizes low density. If apartments are illegal across large areas, the market is forced to ration homes by price. That sounds technical, but it's a wealth policy. It decides who can live near good jobs and schools, and who must commute from the margins. Approval timelines add another constraint that looks boring but behaves like a tax. A project delayed by years must carry land costs, legal costs, and financing costs the whole time. Developers don't get paid for good intentions. They get paid when units are finished and occupied. When uncertainty rises, fewer projects pencil out and supply shrinks further. Construction costs have also moved upward in many countries. Labor shortages, materials volatility, stricter codes, and higher insurance premiums raise the break-even rent. Infrastructure quietly sets the ceiling too. Even if a city wants new homes, water capacity, transit, schools, and grid connections have to exist in reality. So the shortage is partly physical and regulatory, but the reason it feels impossible is that housing is not treated only as shelter. For households, a home is often the largest leveraged purchase they will ever make. For institutions, housing is increasingly a long-duration cash flow asset. That dual identity creates a permanent conflict. People need homes to be affordable, owners need assets to hold value. You can balance those goals, but you can't maximize both at once. This is where cheap credit enters the story, because most housing is bought with borrowed money. When credit gets cheaper, buyers can bid more without feeling richer month to month. Over the last few decades, many economies experienced long declines in interest rates. Lower rates raise asset values broadly, and housing is one of the most rate-sensitive assets on Earth. The math is simple. If a payment stays the same and rates fall, the loan size can rise. In a constrained city, that extra borrowing power mostly capitalizes into land prices. Central banks don't set rent directly, but they set the price of leverage, and leverage is the bridge between wages and house prices. After 2008, the supply side in several countries weakened. Builders failed, skilled labor left the sector, lenders tightened, and construction pipelines broke. The US is a clear example. Housing starts collapsed after the crisis and took years to recover. Underbuilding for a decade creates a backlog that doesn't disappear because a mayor announces targets. Then, in the 2010s and early 2020s, low rates and abundant liquidity pushed investors to hunt for yield. Housing started to resemble a bond with maintenance calls and local politics attached. Institutional investors did not invent the shortage, but they learned to monetize it. Pension funds, insurers, REITs, and private equity like predictable income streams, and rent is an income stream. Follow the cash flow and it becomes less mysterious. Capital buys property, debt finances part of it, and tenants rent service interest, principal, and a targeted return on equity. In a loose market, that target is negotiable. In a tight market, rent becomes whatever clears the queue, not whatever feels socially reasonable. This is why vacancy rates matter more than debates about greed. When vacancy gets very low, price discovery happens through displacement, not negotiation. The tenant is not bargaining against the landlord's costs. The tenant is bargaining against the next applicant who can pay slightly more. Demand shocks are now routine because opportunity is concentrated. A few winner cities pull in graduates, immigrants, and high-wage sectors faster than housing can respond. That changes who sets the price. A local teacher isn't bidding against a hedge fund, but they may be bidding against the income profile the city attracts. Short-term rentals can tighten the squeeze in certain neighborhoods. Each unit shifted from long-term housing to nightly stays matters most when the market is already near empty. There's also a subtle ratchet effect in rents. Rents tend to rise quickly in booms, but fall slowly in downturns because moving is costly and supply is sticky. Governments sit awkwardly in the middle of all this. They pay the social cost of high rent, but they also benefit from rising property tax bases and the optics of wealth. And homeowners vote in high numbers. Scarcity protects their balance sheets, so scarcity is often defended as planning prudence. Policy responses can help, but they often collide with the underlying constraint: permission. Subsidies raise purchasing power, and in tight markets, that can raise prices unless supply expands. Rent regulation can protect incumbents, but if poorly designed, it can reduce maintenance or discourage new builds. Housing is one of those sectors where a policy can be morally attractive and economically self-defeating. What actually changes outcomes is whether renters have a real outside option. Without one, the market is just a competition among tenants. Tokyo is a useful counterexample, a huge city that has often kept housing more attainable by allowing faster, denser building. The lesson isn't that Tokyo is perfect, it's that abundant permission changes prices more reliably than speeches do. Vienna is another. Large-scale social and regulated housing doesn't eliminate markets. It limits landlords' pricing power by creating alternatives that are credible, not symbolic. Now bring interest rates back in because they reveal the system's fragility. When interest rates rise, prices can cool, but in a true shortage, rents may stay high because people still need somewhere to live. Higher rates also raise landlords' refinancing costs, and in tight markets, they try to pass that through where rules allow. Housing is safe often means housing is politically protected, right up until the politics changes. So who benefits from the shortage? Existing owners, landholders, and investors whose returns improve when scarcity makes rent growth reliable. Who pays is broader: renters, younger households, essential workers, and employers forced to cover a cost of living they didn't create. The key insight is that scarcity is not only a problem. In many places, it is the business model, and the future hinges on whether politics finally chooses abundance over asset inflation.
Thanks for watching. This is Global Flowlines. Subscribe for more videos.